All right, so stocks followed up a really strong week last week with a pretty sideways move for most of this week. So since I wasn't here on Monday and Wednesday, I'm going to break down pretty much what I saw for the whole week here with today's video as we go into a new week next week and what we should expect. What do we take out of this really good rally we've had pretty much since mid-June? So for more than a month and a half. Is it the rally? I mean, from what we're hearing from some people on TV or on Twitter, that this is the rally that will take us up to new highs, up to 4,800 and beyond by the end of the year and into next year. Or do we have, is this kind of a bear market rally, which is the other side of the debate that you're hearing a lot about? So I'm going to break down kind of what the indicators and charts are looking like, how bullish we've been, how bullish we can continue to be at these levels, and what may be throttling some of that momentum. We'll also take a look at how the sectors perform, different asset classes, and our trade idea of the day is a stock that's trying to do its own little breakout pattern, and we'll talk about how to trade that going into the next week as well. So let's go ahead and get started. Today is Friday, August the 5th, 2022. This is the Market Outlooks from MarketScholars.com. My name is David Settle. All right, before we get started really quick, I invite you to subscribe to our YouTube channel. Mouse over this icon right here on the bottom right corner of your screen. Click that thumbs up icon down below and like our video. Comment what stood out to you. Join our website at MarketScholars.com. Use that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, along with these things over here on the right, come down and click on this heart. It opens up this new tab. Hit that like button there. Do the same thing with the Facebook post. Click that thumbs up icon. Click that like button as well. Again, the more you do that, it helps get our content out to more of the followers that are following us on those accounts. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. So we had a down day, but an open candle, which means we gapped down and rallied throughout the day today. In fact, if you notice, we've had two of those in the last 5 days. We've had 4 down days in the last 5, but 2 of them have been open candles. The other 2 have been filled in. That tends to happen when you're in this kind of convergence mode that I'll show you here in a second, that we're kind of headed towards on the bullish side of things. Kind of limits our upside, but also limits our downside when you're in this. Same thing that we talked about over here when we were in the bearish convergence mode. It limited our downside and limited our upside, and that's kind of what we're getting right now. We are well up above the 30-day moving average, as you can see down at the bottom. We kind of peaked here a couple days ago. We've been kind of grinding, converging ever since. Easily over 5% above that peaks. Again, that's the highest peak that we've seen in the past year, but that's easily above that 2.5% mark, which is what we've talked about as the key to being in a bullish trend. Dark green shading in the green line still. The intermediate lines above 90th percentile. We never did get a cluster. It became pretty close. We never did get a cluster here with both the momentum and the near-term lines in the upper reversal zone. Now they're dropping. The near-term line's dropping. If you notice, we're still on a near-term rally here. This same near-term rally, we haven't ended that. So it's basically been 1, 2, 3, 4, 5, 6, 7, 8 days now that we've been on this near-term rally. And it looks like as of right now, we're kind of diverging here. So we might be getting towards the end. Again, this was our last near-term decline. So don't think that a near-term decline is that big of a deal, right? It can be very minimal, just like the last one was, when the last time the near-term line dropped. Now, we didn't get a divergence, and it wasn't quite 8 days. It was barely 7 days, but still, again, near-term declines don't mean we necessarily have to fall back down. This is easily a higher near-term high, and we'd have to fall pretty low to get to a lower near-term low point there. So, we're doing pretty good, even despite the fact that we might be kind of rounding off here right now at the top, at least in the very short term. That's the S&P 500. Let's take a look at the NASDAQ 100. The NASDAQ 100, if you notice, has really kind of moved into this area. So you see there's a lot of lines here at this 13,000 area, a little bit, a couple plus or minus a couple hundred points. It is a 13,000 point index. So, but you notice you have the 38% retracement level from this long-term decline we've been on since the beginning of the year. You have the red and black lines that are 23% retracement levels and 38 for the black. Off of the black line would be the COVID low point, and then the 23% line, the red line, would be off of the last bear market low that we had back in 2009. So needless to say, we're at a very important convergence here of Fibonacci retracement. The green 50% line is also, and that's of this decline, the current intermediate decline that we are in the process of retracing right now. So really important level here. Again, another reason why we're kind of stalling, and we are, significantly above the 30-day moving average there too. But you see how bullish we've been, especially in the NASDAQ. NASDAQ even more so than the others. But the others too, like the Russell 2000, it didn't quite get up to this level. It would be what, 1950, 1960, where the 62% of the current intermediate decline, the 38% of this current market sentiment decline, and the 23% of that bear market low point, it's all sitting there. But we are kind of in the black lines here, so we're a little bit above that black line. So you see how important this level is that we're at right now. Again, you can kind of see a little bit of a divergence on the near-term line as well. A very good bullish move today. Even if we did gap down, it's kind of a reverse. It's kind of an engulfing pattern, but again, bullish engulfing patterns occur at the bottom of a trend, not after we've been bullish for quite a while. So fascinating move. You would consider it an outside day, a higher high and a lower low. That would be an outside day and can be considered, a little bit of a kind of like an engulfing pattern. In this case, would be more of a bullish bias to it because we finished the day near the high instead of finishing the day near the low like a regular engulfing pattern would look like. Okay, let's go back now to the S&P 500. And since we finished the week, let's take a look at the weekly chart. Now you notice we had a really small week, 80 after a 229 point range last week, 193 the week before that, 160 the week before that. We didn't even get to 100 this time. We were at 87 points for the S&P 500. Very similar to kind of over here where we had a 300 point range, then 121, 129. We really dipped after some big ranges here, and a really small body too. That we ended up with a really small body here as well. The difference between the open and the close as we head up into the 30-week moving average, and again as we head up into some important resistance levels at these Fibonacci retracements. The near-term line did get into strong, above the 90th percentile on the weekly chart, though it did that in March too with the momentum line. So if anything, that had the best opportunity of being more bullish, kind of a bullish breakout. It did get above the 30-week moving average. We're not quite to that point yet here, even if we got a good level, and we're also, you can see, still below the 30-week moving average by about 1.5 percentage points. Looking at the NASDAQ 100, again, we're right up to the 30-day moving average, so really important, another important resistance level for the NASDAQ 100. And then the Russell 2000, we have light green shading and a yellow line. We actually finished a smidgen above that 30-week moving average, just a smidgen, 1/4 percentage point, as you can see down there at the bottom. So it'll be, again, is that going to be a light? Is that going to be a bearish pattern like what a light pink shading and yellow line would be on bullish trends? So really important to see whether or not we end up holding these resistance levels on the market forecast chart. When you look at the Hakinyashi candles, another good bullish candle. We did not close above the high like we did last week, but at least we did get a higher close. So that's a good sign. Really good strong bullish candles. You can see, again, about the same size of a bullish candle as we saw last week. Really strong, really big bullish candles, relatively speaking, compared to what we've seen in the past. Same thing on the NASDAQ 100. This is the biggest candle we've seen in a while on the NASDAQ 100. And then, of course, your Russell 2000, very similar. So that PPO is rising across all the board, but we're still not quite back above, above the 10-week, and we're getting good bullish closes, not above the 40-week, which would be similar to the 200-day moving average, which again is sitting at that really important confluence of Fibonacci retracement levels across multiple time frames, sitting right on top of each other. Your NASDAQ 100 it's the same thing. So here we are at those levels. The 40 week is right above them. So we'd have to really break through that other layer of some strong resistance as we get really, really close up to it. Let's go down to the 3 green arrow chart. So give me a second to pull that up. You can see we continue to have 3 green arrows. We have 3 green arrows all across the board. What's the closest thing that we have to not getting a green arrow is getting this the MACD getting a red arrow. So the stochastics are not going to give you a red arrow anytime soon. Maybe this week if we get some significant declines, but most likely not even this week. You're not going to get below the moving average again, most likely this week, unless again you had a significant move to the downside, which is low probability right now. You are up to again, those resistance levels, the 38, the 50, and the 23% on the SPY. There's your 38 and 23 down here. We were already well above. Remember, we were just getting to them in the Nasdaq and the Russell. We're already well above them on the S&P. We're approaching this really important 23% line coming off of the last market sentiment low point. So there's not, we get above that and you're starting to trend to the upside again. You can see that also happens to line up with this old low point from March that we're not quite steering our way up above. I mentioned to you on balance volume. If you look at the on balance volume here, and here let's get rid of the market forecast for a second. So when you look at the on balance volume compared, let's go out to the 5-year, go to a daily chart. When you look at that volume that we're at right now, again, compared to like say this this last high point that we had in June that we're really close to, you notice we are not close to it down there on the volume. In fact, those 2 peaks, the last 2 near-term peaks that were easily above, you notice that we are not above them on volume. In fact, we've rolled back over and gotten even more lower. This old low point we had from May, we're easily above on price. We're nowhere near being above on, and then again, that old low point in March that we're approaching is even higher than all of them. So we've got a long ways to go before we can get, from a volume standpoint, above some really important levels to support. The other thing too, from a breadth standpoint, is this McClellan oscillator that's been positive. We've had a really good positive level. Today we're at 43. We got to 43.9. We're getting really, really close to 470. So we're really close to 500. But as we're approaching 500, we're already oscillating back down. As we saw over here, you will oscillate back down. That's what this is, a McClellan oscillator. And again, the issue is you would like to really break through 500 to really kind of signify the reversal of this pullback, right? The pullbacks get you below the minus 500 level. The corrections get you below minus 500. So to get back above 500, you really want a good, strong oscillator that lasts quite a while, get you through 500 and stay there, get you through 500 and stay there, get you through 500 for the most part and stay there. You came back a little bit, but didn't get back below 0. But now here we are again. We didn't get above 0 in March. We didn't get above 0 in June. And now we are above 0. So that's a good sign. But we're not above 500 yet. And again, by the time the oscillator went negative here in 2018, we were well above 500. By the time the oscillator went negative coming off the 2016 level, again, we were well above 500. So if we go negative here early next week on this, and without this summation getting above 500, at least significantly above 500, then again, it kind of shows you, just how not bullish we are yet, despite how great of a move this was. You also see that too showing up over here in the new highs and new lows index. When you look at the new highs and new lows, again, getting above 0 is great. We got above 0 early yesterday, we were not able to stay above zero, and obviously not anywhere getting close to being above positive 100. See, back in March we got above zero too, but we couldn't get above positive 100 and can sustain that bullishness there. So, again, and like what we saw here, the average has really moved up, and so it makes it really easy for us to break back down below the average. And when you're below the average, that's when you're bearish. When the new highs and the new lows get below the average, the average has been bearish pretty much since coming off of that Thanksgiving low point. Right, we were already bearish going into that last high point there, but the average didn't get down there until the S&P broke down post Thanksgiving. That's when the average finally broke below zero. And the average has been below zero ever since, with the big thrust to the downside coming when when you were below the average, right? When the actual new highs and new lows were below the average, and you got some rallies when it came back above the average. So right now we're above the average, and the average is really high, which again makes it susceptible to breaking back down. Again, for some perspective, let's go back out to some of these last corrections like 2018. You can see here. So here's what it looked like coming off that 2018 low point. You can see by the time we were positive, at least getting close to being positive at the early parts. So we didn't get above positive 100 for a while either. But you notice we were nowhere near the average. So it would have been really hard for us to roll back down and get back below the average, which is where you get when you're bearish. In fact, we stayed above the average that entire rally, even as the average finally turned positive. We stayed above that average for a good chunk of time. Brief little pullbacks, but the average went positive and we were great. Well, the problem right now, again, is the average is not positive yet, and we're very susceptible to a move back down below that average, which would obviously coincide with a move back down in price. One other positive thing we have going on, let's take a look at some of these other oscillators here. Looking at the RSI and the CCI, you notice we've been above 60 easily. We haven't gotten above 70, which is what you like to see on that first thrust out of bearish territory into bullish territory. Same thing you see on the downside. When you get out of bullish territory into bearish, you like to have a thrust down below 30 to change the trend. So we haven't had that thrust above 70 yet to really change the trend. We didn't really get above 200 either, which would have helped us change the trend on this side. As you can see, we got down below, or really close to minus 200 over here on that move when we changed the trend to the downside. So we haven't got that yet here. From an Ichimoku cloud, we are above the cloud. We do have a strong trend, intermediate trend strength going. It is not a mature trend. Like, we're not above 5. We're not above 80 yet. We're kind of stalling here at 80, and again, like I said, not anywhere near getting above 5. So we're not getting a strong trend developing here, not yet at least. From a DMI standpoint, we did easily get above 30, but you notice now the positive has fallen back below 30. We got easily below 20, but now the negative is rising. So we did get light green shading, but we haven't transitioned that yet into dark green shading, which is what you'd like to see when you've really got a good bullish trend going, that ADX gets above 25. But we need to stay above 30, stay below 20. So this needs to be kind of a one-day thing, this reversal to the downside. Looking at the Bollinger Bands, we got outside the bands. The bands got outside the Keltner channels, as you can see here. The bands did get outside the Keltner channels. Got some strong positive momentum going. Again, we haven't seen this kind of strong momentum in quite a while. We've been above the Keltner channel and briefly above the upper band there. So good sign from that perspective. Good breakout, good rising bandwidth, higher than a lot of other peaks that we had seen previously. Now we need to sustain this, right? Now we need to sustain it kind of like this, where we just continue to ride above that, or ride along that upper Keltner channel, above it, below it, and we stay in the upper quartile. So we're right on the edge of coming out. So you see kind of how, like, we've got some good things going for us, but you also see kind of how tenuous that good thing can be, and how we really need it to sustain. Here's the where we are relative to stochastics. Again, like in April, that 20-day average has gotten up here. Unlike April, when the 20-day average finally did get above 80, the blue line was already down. So this, like some of these other periods, when over here when the orange line, which is the 20-day average of the blue, got above 80, the blue line was still above 80. So we were still closing. What the blue line is the current close relative to the 4-week range. So 100 is at the 4-week high, right at the high, and 0 is right at the 4-week low point. So we are obviously pretty darn close to the 4-week high point. You see that in the Arun indicator as well. We are really, really close to the 4-week high point, and we've been kind of falling here. But now you notice the low point is set up. The low point is set up. It's getting close to 0, and just like we talked about before, once the low point gets to 0 and the green line gets below 70, then you're susceptible for the breakdown of the 4-week range. Well, I don't think we're anywhere close to that. We're not anywhere close to the 4-week low point right now. But you see how, we're getting like a sideways move. We're not trending higher. We're getting really small moves to the upside. And you're going to have this low point's going to be there for another week. By the end of the week, it will move up a little bit, and then it will start to move up a little bit more rapidly. But we're nowhere near that low point now at 370, and we're not going to touch that low point. But we need to keep getting new highs, and if we don't keep getting new highs, we got a lower high and a lower low. We ultimately did close above yesterday's high point. We closed above last week's high point. We closed above yesterday's low, so we weren't as bearish as it seemed. We ultimately did close above last week's high point, which is a good sign. So that would be pretty much Friday's close. We got below that on Monday and Tuesday. Got above it on Wednesday. Stayed a smidgen above it Thursday. Opened well below it today, easily below it, before finishing slightly above it. So pretty not very much of a range after a really good breakout move post FOMC. Well, actually going before FOMC, but then post FOMC. But really good breakout move in those 3 days. One of the bigger 3-day rallies we've seen in a long time, as I talked about last Friday in the Market Outlook video. That's what we followed it up with, right? This kind of sideways move. As you saw, not surprisingly, your VIX ended up at the lowest level of the week, and really the lowest level that we've seen in a while. It ended up being a little bit bullish there relative to the VIX 3M, but that's the lowest VIX 3M we've seen since that March, April. Now that March, April, we got below 20. And this got below 85%, all the way down to 80%. This time around, we're still not below 20, and the VIX is still not dropping below 85%. And the VVIX over here, when we dropped down in March, April, we were about 105. We're down to 85. But you notice we're not really going any lower, and that VIX range is continuing to get smaller. Like we're under 8 points. It's starting to compress a little bit when you look at it from a monthly perspective. You can see here, if I were to go to this chart here and look at the range for the VIX, in the last, the daily range is the lowest it's been in a long time. So the VIX is really, really grinding lower. It hasn't been this low since October, November 2021, so a little bit more than a year ago, and you can see we were below 20 when we were this low. We are not quite below 20 yet. We were below 20 on the daily chart. If you look at on the weekly chart, a 6-point range on the weekly chart, we ended up with a 6-point average range. We ended up with a 4-point range, and when you look at it on an options expiration cycle basis, because we're really close to options expiration cycle ending. There's our expiration cycle. 11-point range is the average right now, and we had a 5-point range this time on the VIX. So very, very small range, even if it was to the downside, a very small range for the VIX with a really, really low VVIX. The lowest VVIX that we've had at the end of an options expiration cycle that we've had since May of 2019. And you can see what happened the next 2 months after that. And remember, again, as a reminder, the seasonality of the VIX and of the VVIX, you can see that the seasonality of VVIX is to rise going into August expiration and really going into earnings season in October. That's the seasonality for the VVIX, and the VIX goes along with it all the way in again to that earnings season into October, and one last hurrah going into the beginning of November. So this is a time of year where the VIX typically rallies, and we're actually starting that seasonal time with a pretty good move to the downside on the VIX. So keep that in mind too in terms of what we expect to see. Again, especially going into options expiration this week. Some more earnings. We had the big basket of earnings now behind us. We also have inflation numbers coming up, and all the other factors with the market heading into some significant Fibonacci resistance levels and volume resistance levels. We spent a lot of momentum to get here. We talked about that last week, and you saw this week has been sideways as can be. Have we used up all our momentum? Right? Are we going to be converging here for a while and kind of stuck at the best case scenario, or are we going to, in a worst case scenario, start to retrace? I think the higher probability is we'll start to retrace a little bit, at least to a higher low point than what we saw in mid-June. Kind of again, best case scenario where we form a inverted head and shoulders pattern. Kind of your worst case scenarios, we might retest those lows from mid-June again. I think that's starting to work its way down the lower probability. But I think considering the seasonality things, the resistance levels we're heading into, and the kind of technical patterns we're getting, it appears that we're kind of working towards a little bit of an exhale going into and out of August expiration and into this seasonally bearish time of year. What do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Tell me what charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am. All right, if you take a look now at what's driving the price action today, you can see commodities have just been the biggest loser the last 3 months after being a really significant winner. In fact, if I were to switch this out to 6 months, you can just see how bullish this has been. It's been a really significant winner. But the dollar has really kept pace, is now the best performer over the last 6 months. Obviously has been the best performer over the past 3 months, with everything kind of flat to down, with even equities and underperforming bonds to a small degree. Qs and IWM are close to where bonds were after starting off pretty bearish there by mid-June. Really coming off of those June low points, which would be what, the 17th. From the 17th going forward, since the time that the Qs and IWM have taken off, there's a small loss in SPY there at the open. But since that time, you can see they're up nearly 20%. The Qs are up nearly 20%. Got up close, 19.5% there off of that low point, off of that day, off of the close from the prior day on June 16th, not necessarily off of the low. And in that same amount of time, yields have been down, while bonds have been rallying. So yields have been down. The dollar's been bullish, which has helped pressure some emerging markets and developed markets to a smaller degree. And you can see the dollar has also pressured gold and to an even larger degree commodities. So this big sharp drop in commodities relative to the Qs has been an interesting pattern to look at. If you look at here, if we look at the correlation between, let's take a look at the correlation between the Qs and commodity prices. So here, let me get QQQ up here, and I don't think that took. So let's switch this again, the commodity prices. There we go. You can see the correlation here. Let me zoom out a little bit more for some perspective on this. The correlation had been negative. It's generally been pretty positive since the beginning of the year. For most of this year, the correlation has been strongly negative. So when the commodities are rising for most of this year, the Qs were falling pretty sharply. And you could also take a look at yields from that perspective too. So when you look at the Qs with yields, they had also had a pretty negative correlation, continue to have a negative correlation right now. So you can kind of see it's the inflation story with yields and commodities really pressuring the Qs, and the lack of an inflation story over the last little bit has been helping the Qs rally. Like I said, without a whole lot of volume, so you're not pushing through resistance, but it's helped lift it off of those lows, the lack of this inflation story. So when you look at the 10-year yield, which had been breaking down below its 50-day moving average, the MACD and stochastics rolling over, it's been pretty bearish, and it got below this 38% retracement, and it looked like the 10-year yield was going to really start to break down, right? Especially with the Fed not raising, Fed still raising rates. Like the 10-year yield was below where the midpoint of the Fed funds range was, but not now. Like not since that open where we got the low point of 252 on August the 1st, August the 2nd. We are now up over 30 basis points off of that low point, with a move higher back above the 17-day moving average, and the MACD moving higher above its moving average, even more than it did here in mid-July. So it looks like there's a good chance that yields might really start to ramp up a little bit. Now that we did not see that in commodities. Commodities did not ramp up today, but you notice they're still sitting. They have filled in the gap between the 50 and the 200-day moving average. We've been in convergence mode for a long time. The MACD's been above. The MACD now has dropped back down below its moving average, with us being below the 17-day. So if we break this 200-day, we could be back into divergence mode. Otherwise, if we end up holding support here, as you expect that we would, then you can see again a rise in commodities and a rise in yields. If that's where we end up going towards, again, has been bearish for the Qs. And the other factor too that you saw today was a big jump higher in the dollar. Now, it hasn't broken out of its range yet, so it's not, this is hardly a breakout on the US dollar, but it is a move back down towards the lower level of this last 4-week range that we've had here. If me get to a bigger, so we can see all of the 4-week range on the chart. There we go. So you can see that where the euro and the dollar have been kind of trading in a really sideways move, trying to see whether or not it's going to get back to parity or not. And now today's move coming off that employment report was a move higher to the dollar, down towards the bottom of this sideways range. And if you look at the US yen, US dollar, Japanese yen, you can see the dollar's really moving higher on the dollar yen. So you're getting a much more significant breakout here, back up above some of these moving averages again, with the MACD and stochastics rolling up too. Again, the dollar, strength in the dollar at these levels is not very conducive. In fact, if you look at the euro US dollar, and you look at the last time that we were approaching parity like we've been now, like we are doing now, excuse me. In fact, let's just go back as far as we can. Let's just go to maximum. The last time we were near parity, at least approaching parity here, was in 2000. It was the last time we approached parity to the downside. And of course, we all know by the end of and at the beginning of 2000 was also the other time that we saw this here, this pattern, right, where we had, like today, a very strong. In fact, in March of 2000, it was announced in April, we had the strongest jobs gain in 30 months. So it had been 2.5 years since we had a gain. So that, going back all the way to 1997 was the last time we had a jobs gain of that high. It was an abnormally high jobs report. On March of 2000, the yield curve on March of 2000. If I come back over here to the yield curve, which is right here, and let's go out to 1980 with a daily chart. Now let's look at where the yield curve was, because right now the yield curve is right around this 40 basis points level here. It hasn't been updated yet for today, but you can see today's result here is at 40 basis points. It's been floating around 43, 41 basis points most of the day. So when you look at, okay, well, in March of 2000, let's it goes back all the way over here. We were also right about at 43 basis points. So very similar, and then we never have gotten that low again. Even in 2006, we didn't get 43. We never even got 25 basis points below. So this is the last time that we've had a yield spread this low, where the 10-year was this far below the 2-year in purple. So you can see what it looks like up here. There's the black, and then there's the purple. It was really the black was, the purple had rallied up, and the black was coming down away from the purple, and the Fed was not cutting rates yet, right? So you had a pretty significant, and the reason why is because you had a jobs number that was still strong and growing at very high rates all the way. But then you notice by the time we had that last good number, that was the last good number that we had. So here it is right here. If you look at it, there's that March 2000, 472 again. I mean, the last time we had above that was in September 97, and that was the only other one. March of 1994 wasn't even that high. So that was a real big move, but you notice that was the last hurrah. Yield spread at nearly 50 basis points, over 40 basis points. Big move higher. This would have been in April, right? Big move higher, and so by April you can see we were even lower. By the time we would have got early April, that jobs report, we were around 45, 50 basis points, very similar where we're at right now. We had a great jobs number, and then it fell off, right? And then that was the peak. And that's really when the correction started. Remember, the correction really didn't start till the very end of 2000, but the NASDAQ started to fall there in April of 2000. So you get the idea, like we've seen this pattern play out before where jobs growth is really strong. Inflation levels were relatively strong. So remember, inflation levels back then for, let's see here, for the S&P going into March of 2000 would have been right there. They were peaking, at that particular decade, 10-year peak would have been 3.75%. Again, well below. If you look at the Fed funds rate, March of 2000, you can see or April 2000. By the time we got that, we had a 300 basis point positive real Fed funds rate. Again, we are very, very negative. So the Fed's not going to be cutting rates anytime soon. The Fed's going to continue to raise rates, which again puts a lot of pressure on that employment report and that yield spread, which is already at levels that we last saw with the real Fed funds rate way up here. And the last time the Fed was able to stop raising rates was this kind of, or stop doing their restrictive policies, was this kind of June 5th, this kind of 2015, 2016 levels. You can see the real Fed funds rate was slightly negative, that's slightly positive. So they were able to kind of pause a little bit. And then 2019, they cut rates, mid-cycle adjustment. And they were able to do that because the Fed funds rate, they're not going to be able to pause or cut interest rates anytime soon with a real Fed funds rate that's still very sharply negative. And this, of course, will be updated next week when we get that CPI data. Let's take a look at the sector rotation and how it performed here today. Finishing off, let's just go to the full week and see how it finished off this week here. There we go. So you can see your big winners were the three that you expect to be the big winners of a bullish week. And it really wasn't that bullish of a week, which kind of goes to show, remember last week we had a good strong week and it wasn't these three that led the way higher. This week, these three lead the way higher. It wasn't a good strong week. It was end up kind of a really, really flat week. And you can see that really the biggest loser was the energy sector. So it goes to show where the leadership is and how it's not really providing that strong leadership we need to see to sustain a good, strong rally. Up through, especially when we're trying to get through a ceiling that we haven't had to get through prior to this year before. All right, now let's take a look at our trade idea of the day. One stock that really benefited today with a really strong move to the upside, with a strong momentum move on its momentum line, getting up to the 90th percentile. And getting, again, more than 1.5% above the 30-day moving average, a bigger move above the 30-day moving average that we've seen in a while. Dark green shading the green line, that's JP Morgan. This financial sector, it's been pretty bearish, but you notice these candles the last few weeks have kind of stalled, and you notice this really sharp PPO to the downside. It appears to be rolling up to the downside here. When you look at this 3 green arrow chart, we got 3 green arrows again, with the MACD now turning positive slightly, as you can see here, turning positive slightly there. Slightly, barely negative, and you can see the stochastics also barely negative. I mean, these were kind of flirting with 3 green arrows all day long, with a pretty good above average volume and a pretty good breakout type move, engulfing, getting above the last 4 days highs and really getting close to breaking through an area very low, an area very low volume, and getting through some moving averages that have all converged on each other, right? You take a look at some of these other oscillating charts. Like the DMI, that positive indicator, which had been pretty bearish, really reversed course, is now up above the negative indicator in the neutral territory, trying to make a change in direction there. The RSI not quite getting into bullish territory yet, but it's getting at higher levels than what we've seen. The CCI not confirming that bearish breakdown, really reversing it rather rapidly. Looking at the Ichimoku cloud, we had a strong bearish trend. We are above both the green and blue lines now, the green above the blue line as well. Still below the cloud, no trend developed, but again, we have ended the bearish trend that we had. And when you look at the Bollinger Bandwidth, it's been really small. So the Bollinger Bandwidth is setting up for a breakout type move. And again, not in the upper quartile yet, but the highest level we've seen in quite a while in terms of where we are in the bandwidth. So we're really setting up for an opportunity to the upside. We're not quite there yet, but at least we know the bearishness has ended. So what we decided to do is come over to the September options, 42 days out, and do a bull put spread. So sell the 115, buy the 110. It's a little bit more aggressive of a bull put spread. It gives me a higher credit than normal, so I'm above that 300. We typically like to get at least $300 for $1,000 of risk on a short premium spread like this. So we're at $300, but we're not at $1,000 of risk. We're actually less than $1,000, much less, because it's a little bit more aggressive, a little bit lower probability. But that lower probability is reflected in less risk that we have to take to get that $300 move. And as long as we maintain the levels where we're at and move slightly higher, we don't need a big move to the upside, as we feel pretty confident the downside now is limited. As we've really been grinding this move, and I didn't show you the weekly chart here on JP Morgan, but you can see we've been pretty bearish, but now the MACD is above its moving average, as we are like pretty much done going lower. Right? We might not be going higher yet and getting above the 17, but it doesn't look like we're going much lower either as we get into bearish convergence mode, with a strong amount of volume here this week to help support this bullishness that we saw this week. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join our website at marketscholars.com, like us on Twitter and Facebook. Have a great rest of your weekend, everybody, and we'll see you all next week.